Operating a maritime vessel is an incredibly high-stakes financial endeavor, regardless of the size of the ship involved. A single accident on the water can cost millions of dollars in liability. But the vessels facing these risks operate on vastly different scales. You have massive ocean-going freighters hauling thousands of containers across the globe, and you have nimble, specialized harbor tugboats maneuvering them into port. For well over a century, the standard way to insure these vessels has been mutual protection and indemnity, or P&I. It is a member-owned, shared risk pool, originally designed by and for the owners of those massive international freighters. Participating in that mutual structure, however, carries a hidden financial danger for its members, known as supplementary calls. If a mutual club experiences bad claims and the shared pool drains, the system demands additional cash. Every member gets a surprise bill. Large conglomerates can absorb these bills, but small operators cannot. A single unbudgeted call can shatter a tugboat's operating budget. For a small maritime business, participating in a shared risk pool translates to unacceptable financial volatility. The constant threat of a ruined budget makes long-term planning incredibly difficult. To solve the problem of unpredictable supplementary calls, many small vessel owners look outside the traditional member-owned pools and turn to the commercial insurance market. The specialized tool they use is called Fixed Premium P&I. Fixed Premium operates strictly as a commercial transaction. The insurer is a separate corporate entity taking on risk for a profit, rather than a shared community pool of ship owners covering each other's losses. This changes the relationship entirely. The maritime operator shifts from being a co-owner of a risk pool to a straightforward customer buying a guaranteed product. Let's look at a scenario involving a small tugboat owner seeking an annual insurance policy. The tug owner and the commercial insurer agree on a specific fixed advance premium. For this example, let's say it is exactly $50,000. That price is absolutely locked in for the entirety of the policy period. Now, imagine a worst-case scenario. Over the next 12 months, the commercial insurer suffers millions of dollars in unexpected claims across their portfolio. This chart shows the defining rule of fixed premium. In the background, insurer claims spike aggressively. In the foreground, the premium remains flat at $50,000. Despite massive losses, the commercial insurer absorbs the shock, acting as a shield for the operator. This mechanism provides small operators with absolute budget certainty. They know their exact costs on day one, giving them the ability to plan their year without fear. Returning to the broader economics of the maritime industry, absolute financial certainty always comes with a structural trade-off. The primary limitation of fixed premium P&I is that it offers significantly lower coverage limits. This side-by-side capacity chart shows exactly why. A commercial insurer does not have the bottomless overspill reserves of a massive mutual pool, so they cannot legally or financially offer infinite coverage. The fixed premium bar on the right hits a very clear, solid ceiling limit. Because of that hard cap, fixed premium is inadequate for the multi-billion-dollar catastrophic exposures faced by massive ocean freighters. Instead, it is built for a highly targeted demographic. It serves small to medium-sized specialized vessels, like tugs, barges, and workboats, whose risk profiles comfortably fit under the commercial cap. Fixed premium P&I requires abandoning the infinite safety net of the mutual system. But in exchange, it gives small maritime businesses the predictable foundation they need to survive.